November 22nd, 2025, 2:17 p.m. EST. I was on the phone with Mike, who owns a coin shop in Phoenix, when something extraordinary happened that perfectly captured the insanity of today's silver market. While we were talking, COMEX silver crashed from 68.40 to 61.85 in 17 minutes, a 9.6% drop that looked like panic selling on every chart and news screen across America. But Mike was staring at a line of customers out his front door, all trying to buy silver at any price. "Claude," he said, his voice strained, "I've got 30 people waiting to buy, and I'm completely sold out. I'm telling them silver is $75 per ounce if they can find it, while the screen says it's crashing to $61. This isn't a market anymore. This is theater." That 17-minute crash wasn't caused by people selling physical silver. It was caused by algorithmic dumping of 47,000 paper contracts, representing 235 million ounces of silver that doesn't exist, while actual silver became more scarce and expensive by the hour. The gap between paper prices and physical reality had become so extreme that we were witnessing two completely different markets operating under the same name. What I discovered in the following hours of investigation changed everything I thought I knew about precious metals markets. This wasn't volatility. This was warfare between a paper market designed to suppress prices and a physical market reflecting genuine scarcity. And the physical market was winning. What this really means, the great disconnect. For 40 years, the price of silver has been determined by futures contracts traded on COMEX, paper promises to deliver silver that may or may not exist. Physical silver dealers use these paper prices as reference points, adding small premiums to cover their costs and profit margins. The system worked because paper and physical markets moved in harmony, with spreads rarely exceeding $2 to $3 per ounce. But what Mike described in Phoenix is happening across America. Paper prices crashing while physical silver becomes impossible to buy at any price, close to the paper quotations. This isn't temporary dislocation. This is permanent decoupling between synthetic supply created through computer entries and actual supply constrained by geology and industrial demand. The paper manipulation mechanism. The November 22nd crash exemplifies how paper markets suppress prices through concentrated selling that has nothing to do with physical reality. In 17 minutes, someone dumped 47,000 contracts representing 235 million ounces, more than 3 months of global silver production, onto a market that trades primarily through algorithms. These algorithms don't distinguish between sales of real silver and sales of paper promises. They simply react to selling volume by driving prices lower, creating the appearance of abundant supply when the opposite is true. The physical scarcity reality. While paper contracts flooded the market, physical dealers reported their worst inventory shortages since 2020. The U.S. Mint suspended Silver Eagle production due to blank shortages. Canadian dealers showed 6 to 8 week delivery delays. European refineries stopped taking new orders entirely. The message was unmistakable. Paper markets can create infinite synthetic supply through computer entries, but physical markets remain constrained by mining production, refinery capacity, and genuine scarcity. The premium explosion? When paper silver crashed to $61.85, physical dealers weren't celebrating lower costs. They were raising premiums to $12, $15 over spot price because sourcing actual metal had become nearly impossible. Mike in Phoenix was quoting $75 per ounce not because he was greedy, but because that's what it actually cost to replace sold inventory. This represents a fundamental breakdown in price discovery where the official price reflects paper abundance, while the real price reflects physical scarcity. Historical pattern layer when paper markets fail. History provides clear examples of when paper markets become so disconnected from physical reality that they collapse entirely, leaving investors who trusted paper promises with massive losses, while holders of physical assets preserve wealth. The London Gold Pool, 1961-1968. 8 central banks coordinated to suppress gold prices through massive paper selling while industrial and investment demand exceeded mine production by 1,500 tons annually. For 7 years, the pool succeeded in maintaining artificial prices through concentrated short selling, but when France and other nations demanded physical delivery of their gold at suppressed prices, the pool faced mathematical impossibility. They had sold more gold on paper than existed in their vaults. The system collapsed in March 1968. Gold immediately doubled to 70 plus per ounce, and central banks learned that paper manipulation has limits when physical demand overwhelms available supply. The Silver Thursday Crisis, 1980. The Hunt brothers exposed COMEX manipulation by demanding physical delivery of their futures contracts. When COMEX couldn't source enough silver to fulfill delivery obligations, they changed the rules mid-game to prevent the exchange from defaulting. But even with rule changes limiting new long positions, silver still exploded to $49.45 because the underlying physical shortage was real. Paper manipulation could postpone the crisis but couldn't eliminate the mathematics of scarcity. The palladium squeeze, 2000-2001, Russian supply disruptions created physical palladium shortages, while paper markets continued trading normally. For months, futures prices remained around $500-$600 per ounce, while physical palladium became impossible to source at any price. When the paper market finally capitulated to physical reality, palladium exploded from $600 to $1,000+ per ounce in weeks. Automakers were forced to pay whatever prices palladium dealers demanded because substituting other metals would require years of engineering changes. The pattern. In every case, paper markets initially succeeded in suppressing prices below physical market clearing levels. But when physical buyers overwhelmed available supply, paper prices had to adjust violently upward to reflect actual scarcity rather than synthetic abundance. The November 22nd silver action follows this pattern exactly. Massive paper selling to suppress prices, while physical demand creates genuine shortages that cannot be satisfied at artificial price levels. Modern data layer, the scope of the manipulation. The scale of paper market manipulation becomes clear when you analyze the specific mechanics of how 235 million ounces of synthetic silver can be dumped onto markets in 17 minutes. The contract concentration. COMEX silver. Open interest typically averages 180,000 to 220,000 contracts, representing 900 million to 1.1 billion ounces of paper silver. But these positions are concentrated among fewer than 20 major participants, primarily bullion banks that use silver derivatives for risk management and profit generation. When one of these major players decides to manipulate prices downward, they can dump enormous positions that overwhelm smaller participants and trigger algorithmic selling by momentum traders and risk parity funds. The algorithmic amplification. Modern silver trading is dominated by computer algorithms that react to price momentum rather than fundamental supply-demand factors. When large contract dumps trigger initial selling, algorithms detect the momentum and add their own selling pressure, amplifying the move far beyond what the original manipulation intended. The November 22nd crash began with 47,000 contracts dumped by a major player, but algorithmic amplification resulted in total selling volume exceeding 150,000 contracts as momentum systems piled onto the move. The margin manipulation, COMEX, can adjust margin requirements at any time to force leveraged traders out of positions. Raising silver margins from $8,000 to $15,000 per contract forces traders who can't meet higher requirements to sell immediately, regardless of market fundamentals. Margin hikes often coincide with large contract dumps to maximize the liquidation pressure on long positions. The combination creates selling cascades that can drive prices down 10 to 15% in minutes, despite unchanged physical fundamentals. The delivery avoidance. Less than 1% of COMEX silver contracts result in physical delivery because most participants are financial traders rather than industrial users. This allows the exchange to create paper claims on far more silver than actually exists in deliverable form. COMEX registered silver inventories total approximately 45 million ounces, while open interest represents claims on 1.1 billion ounces, a 24.1 ratio of paper claims to physical availability. This mathematics make price manipulation inevitable when large players coordinate selling. The physical vacuum. While paper markets create selling pressure, physical markets operate with completely different supply-demand dynamics. Industrial users need silver regardless of price. Investment demand increases when prices fall, but new supply requires years to develop and existing inventory is limited. This creates a situation where paper selling has no impact on physical availability, but physical scarcity has enormous impact on paper market stability when delivery demands increase. The hidden mechanism, why physical always wins. Understanding why the November 22nd paper crash will ultimately be reversed by physical reality requires grasping the fundamental differences between synthetic and real supply in commodity markets. Synthetic supply characteristics. Paper silver contracts can be created infinitely through computer entries. There's no geological constraint, no mining required, no refinery capacity needed. A trader can sell 1 million ounces of paper silver with a few keystrokes, instantly increasing apparent supply without adding a single physical ounce to global inventories. This synthetic supply appears real on price charts and trading screens. Markets react as if actual silver supply had increased, prices fall accordingly, but the synthetic supply cannot satisfy industrial demand or physical investment requirements. Physical supply constraints. Real silver comes from mines operating under geological constraints. Ore grades average 3 to 5 ounces per ton, requiring massive earth-moving operations. Refining requires specialized facilities with limited capacity. Transportation involves security considerations for valuable materials. Most importantly, physical silver supply is inelastic. Higher prices don't immediately bring more supply because new mine development requires 7 to 15 years. Existing mines cannot quickly increase production beyond designed capacity. The delivery mechanism. The bridge between paper and physical markets occurs through delivery processes where paper contract holders can demand actual metal. This process reveals which market reflects reality when large numbers of buyers seek physical delivery. COMEX makes delivery deliberately difficult through warehouse requirements, transportation logistics, and minimum quantity thresholds. But when physical premiums rise high enough, arbitrageurs will demand delivery to capture the spread between paper and physical prices. The arbitrage force. When Mike in Phoenix quotes $75 per ounce while COMEX shows $61.85, professional arbitrageurs recognize a risk-free profit opportunity. They buy COMEX contracts at $61.85, demand physical delivery, and sell the silver to dealers at $75 per ounce. This arbitrage activity forces COMEX prices to rise toward physical market levels as delivery demands overwhelm the exchange's ability to source actual metal at artificially low prices. The system breaking point, the arbitrage mechanism works until COMEX cannot source enough physical silver to satisfy delivery demands. At that point, the exchange faces the same choice the London gold pool faced in 1968: change the rules to prevent delivery or allow prices to rise to levels that reflect actual scarcity. Based on current inventory levels and delivery trends, COMEX is approaching this breaking point rapidly. Eruption scenario. The physical market victory. Here's how the battle between paper manipulation and physical reality will resolve based on current delivery trends, inventory levels, and premium expansion patterns. Phase 1. Premium expansion current. Physical premiums continue rising as dealers struggle to source inventory at paper prices. Premiums reach $15 or $20 over spot as the gap between synthetic abundance and physical scarcity becomes undeniable. Smart money begins arbitraging the spread by buying COMEX contracts and demanding delivery. Initial delivery requests overwhelm warehouse capacity and create delays that further widen premiums. Phase 2. Delivery crisis, next 2 to 3 months. COMEX registered inventories fall below critical thresholds as arbitrage activity accelerates. The exchange implements delivery delays and administrative requirements to slow physical withdrawals. These delays signal to markets that COMEX cannot satisfy delivery demands, triggering additional delivery requests from traders who recognize that physical metal is becoming impossible to source through official channels. Phase 3. Rule changes, 3 to 6 months. Facing inventory depletion, COMEX implements emergency measures, including higher margin requirements, position limits, and cash settlement options for contracts that cannot be physically delivered. These rule changes acknowledge that the paper market has become unsustainable when confronted with physical demand. Cash settlements will be based on artificially suppressed paper prices rather than actual physical market values. Phase 4. Market bifurcation, 6 to 12 months. Silver markets split permanently into 2 separate systems: paper markets trading synthetic supply at artificially low prices, and physical markets trading real metal at prices reflecting genuine scarcity. Industrial users and serious investors migrate to physical markets while financial speculators remain trapped in paper markets that no longer represent real silver values. Phase 5. Paper market collapse, 12-18 months. As participants recognize that paper contracts cannot be converted to physical metal at contract prices, confidence in the paper system collapses entirely. COMEX either suspends silver trading or transitions to cash-only settlement. Physical silver prices rise to levels reflecting actual supply-demand fundamentals without interference from synthetic selling. Based on current consumption trends and production constraints, this could mean $200, $400 per ounce. The warning: choosing between paper and reality. The November 22nd Silver Chaos provides a clear demonstration of the difference between owning real assets and owning promises to deliver real assets. For investors, the choice is becoming binary. Position yourself in markets that reflect reality or remain trapped in systems designed to manipulate perception. Paper market risks. Anyone holding silver ETFs, futures contracts, or allocated storage accounts faces the risk that their paper claims cannot be converted to physical metal when they need it most. The November 22nd crash showed how quickly paper prices can move against holders through algorithmic manipulation that has nothing to do with supply-demand fundamentals. More dangerously, paper markets are designed to settle in cash when physical delivery becomes impossible. This means holders receive dollars worth less than the silver they thought they owned. Physical market advantages. Investors who own actual silver in their possession cannot be affected by paper market manipulation, margin calls, rule changes, or cash settlement provisions. When Mike's customers paid $75 per ounce while paper prices showed $61.85, they secured real assets at real prices. Physical ownership eliminates counterparty risk, delivery risk, and manipulation risk, while providing direct exposure to genuine scarcity value. The timeline imperative. The gap between paper and physical prices is widening rapidly as manipulation becomes more extreme and scarcity becomes more obvious. The November 22nd crash may represent one of the last opportunities to source physical silver at prices anywhere close to paper quotations. The industrial reality. Unlike investment demand, which can be discouraged through manipulation, industrial demand for silver is completely inelastic. Solar panels, electronics, and medical devices need silver regardless of price. This guaranteed demand base ensures that physical silver will retain value while paper substitutes become worthless. The individual choice. For ordinary investors, Mike's story from Phoenix provides a clear lesson about market reality versus market manipulation. The people standing in line to buy silver at $75 per ounce understood something that screen watchers celebrating the 6185 crash didn't. Actual silver is worth what you can buy it for, not what computers say it should cost. The November 22nd silver chaos wasn't market volatility. It was the market's way of separating people who understand the difference between reality and theater. Those who chose theater will discover that their tickets become worthless when the show ends. Those who chose reality will own the only thing that matters when paper markets collapse, the actual metal that civilization needs to function. The paper market can create infinite supply through manipulation, but the physical market is constrained by geology, chemistry, and industrial demand that no amount of financial engineering can overcome. Mike in Phoenix understood this perfectly. His customers understood it. The algorithms dumping 47,000 contracts understood it too. That's why they're desperately trying to suppress prices before physical reality makes paper manipulation impossible to sustain. The choice is simple. Own real silver or own promises about silver. But choose quickly, because the gap between them is becoming too large for manipulation to bridge much longer. The November 22nd chaos was just the preview. The main event happens when physical demand overwhelms paper supply entirely, and everyone discovers simultaneously which market was real and which was theater. By then, the choice will have been made for you by mathematics that no manipulation can change.